Hello everybody, this is Toni Turner and welcome to the market now as of about 10:30 a.m. on Friday, May the 6th. Wall Street opened lower today after April payrolls data showed the U.S. economy added the fewest jobs in 7 months, raising concerns that the weakness in overall economic activity is spilling over into the labor market. Non-farm payrolls increased by 160,000 jobs last month. That's far below the 202,000 economists polled by Reuters had forecast on average. The data cast doubts on whether the Federal Reserve will raise interest rates before the end of the year. The U.S. economy grew just 0.5% last quarter on an annualized basis, not very big, and inflation has been below the Fed's 2% target for years. Now let's go on and look at 3 charts that could give us some insight into the week to come. First of all, we're going to look at our usual chart of the S&P 500 spider, symbol SPY. This is the ETF that closely tracks our S&P 500 index. But today we're going to look at a weekly chart. It is very advantageous from time to time to get off the dailies and move on to weekly or monthly charts. And as we're at the beginning of May, I thought this would be a good time to do it. Now, if we look at this weekly chart, it gives us a really, again, a good idea of what's going on. We know that in the middle, in May, actually a year ago, in 2015, the S&P 500 made an all-time high of the SPY of $213.78. That's about $21.37 on the S&P 500 itself. We note here that it has not been able to get back to that level ever since that year ago all-time high. We know that in the last quarter last year in 2015, we know that we had a November high of 212. We know that, but that's not almost 214. Of course, the market sold off pretty dramatically in the last weeks of December and into January and February of this year, excuse me. It came back up to its recent April high a couple of weeks ago of 211. So we keep hitting that 211 mark. But so far we've been unable to move above that as well. When I captured this chart today, the SPY was trading at $204.47. You can see we are down on the week. Every candle on this chart represents a week. And so far for this week, the candle is red and we are down. Now I've plotted on this chart a 30-week simple moving average. This is a really good all-around moving average for weekly charts. You can see how nicely the S&P 500 walked right up this 30-week moving average through 2013, 2014, and even into 2015 when it fell down below and the 30-week moving average, you can see that that was a definite negative. So this is a pretty good indicator. So right now that we see that, in fact, the 30-day moving average is at today, $201.54. The black line is right here. So let's use that as support. We'll use as resistance 211 and then on up to the all-time high of almost 214 or 2140 on the S&P 500. But let's use it as overall resistance here, nearby resistance 211 or 2110 on the S&P. Up is good and up is tons of fun, but we want to look at what could happen to the downside here. We know we have support at that 201 level on the SPY, and certainly at the 200 level, which would be the 2000 on the S&P 500 itself. So we want it to stay above that, especially since there was support at that level from the December lows of 2015. If we look down at our RSI, we can see it's a 14-week RSI. We can see it's losing some of its giddy up here, but actually it's just tracking price, so that makes sense. The MACD here on a weekly chart has moved up over its 0 line. That's a good thing. But if the MACD line, the black line, starts coming back in toward the signal line, then of course that means there's a little weakness in the S&P 500 itself. So given that we're going into May, the old saying, leave it in May and go away, is not always true by any stretch of the imagination. We made an all-time high last year at this time. So let's not assume that is going to play out. But what we want to watch here is to make sure that the S&P 500 stays above 201, ultimately 200 itself, or 2,000 on the S&P, and certainly above this 181 mark, which is about 1810 or 1800 on the S&P 500 index. That's the all-time line in the sand for, well, at least for right now. But we don't see that happening anytime soon. So that's our take on the S&P 500 spider. I am cautious getting into trades right now, very cautious as the market seems a little cranky the last couple of weeks, and I remain very nimble. Our next chart is a chart of the iShares Russell 2000 ETF, symbol IWM. We tend to follow this ETF because it follows the Russell 2000 index, and as I've told, this is a small cap index, and as I've told you all, this is a U.S.-centric, mainly U.S.-centric index, companies based in doing business in the United States. The IWM can act as a leading indicator for the broader markets, and that's why we look at it. Now we notice that the IWM has come down pretty straight here for the last week and a half, pulled right down to where I captured it today, sitting atop, and this is the daily chart again, sitting atop its daily 50-day moving average. That's the green line on this chart. Now the 50-day is typically a moving average that institutions watch. So if price goes below, falls below the 50-day moving average, it's something we review as we think about as a slight negative. Also, the iShares Russell 2000, it has price support here just under the 50-day at $108.43, a number I've memorized because I don't want the IWM to fall below it. That could be bad for the market. So today when I captured this chart, the IWM, again, trading right atop its 50-day moving average at $109.80. I'd prefer it doesn't fall below that 50-day moving average, and I'd really prefer it doesn't fall below $108.43. That's near-term support, and it's very important support. If it does, we look down next to 106. So for the broader market, if the IWM moves lower, that's less than desirable. If it moves higher, we can all be encouraged. Our final chart today is a chart of the iShares U.S. Oil and Equipment and Services ETF, symbol IEZ. I'm looking at this chart. Tell you the truth, there's not a whole lot out there at this moment that I want to buy. And I'm not necessarily diving headfirst into the IEZ, but I'm going to keep an eye on it going into next week. The top components in the IEZ are Schlumberger, Halliburton, Baker Hughes, Weatherford International, National Oil Well Varco. And the IEZ, after moving up to about 41 in April, has, with the price of oil moving higher, has pulled back here to its rising 50-day moving average. That could be potentially let's call it a bounce point if the 50-day were a trampoline. Potentially is the major word here, a support for the IEZ. Now, it puts the RSI here, has moved down, which I'm glad, and it is now in neutral position. The MACD is still over the 0 line, which I like, although it's moved down with price. If the IEZ can stay above 36 here, stay above its rising 50-day moving average, I'll watch it. I'll watch the IEZ going into the next week. And if it can move back up, stay above its 200-day, which is coming in right here. And as I captured this chart, the IEZ was just above the 200-day moving average. So if the IEZ can stay above its rising 50-day, stay above its 200-day, and even poke its nose over the 20-day moving average right here at 38, I might be encouraged to buy ever so small share size. I think the jury's still out on oil, but we know there are terrible fires in Canada, and our hearts and prayers are with those people. There's so many people affected by that, and that is not a good thing. But at any rate, for whatever reason oil potentially moves higher, I'll be watching the IEZ again as long as it stays above at least its 50-day moving average. And now let's go on to next week's economic reports. But first, please join us this coming Monday online from 4:30 to 6 p.m. Eastern for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and exchange-traded funds that may be ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, no problem. The recording is available to all of our members a few minutes after the session ends. Okay, now first quarter earnings season is starting to taper off, although companies are still reporting. For the coming week's economic reports, this is the 1 week of the month that we don't have many economic reports. Usually there's 1 week every month where we have fewer economic reports, and the coming week is that week. Monday and Tuesday, nothing of notice. Wednesday, we have our usual crude inventories. Thursday, our usual jobless claims. Friday, the producer price index, retail sales, and Michigan sentiment. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.